The S&P 500 closed above 7,800 for the first time in its history this week, and by Friday afternoon, every single rate call on our board was still losing anyway. Good morning. It's Saturday, August 15th. I'm Nick Vertucci with Ashley Reyes and Marcus Brooks, and this is the weekend edition. No futures check, no what to watch today. We're grading the whole week. A Fed pivot that unwound in 3 weeks flat, the loudest run of AI infrastructure earnings we've had all summer, a public market debut that split this table right down the middle, and a Friday that turned the whole story on its head before lunch.
And I've got some grading of my own to sit through, apparently.
Day 2 in the chair and already a beatdown scheduled.
We'll get there. First, because 4 of this week's 5 biggest earnings prints are squarely his beat, we've pulled Dave Sullivan back into the 4th chair.
Happy to be back. Feels like the whole week was written for this seat.
It kind of was. Let's do the board. And Ashley, I'm sorry to say this one starts with you.
I inherited it. I'll grade it.
Thursday show. Eleanor's last call before you took over. If PPI came in soft and jobless claims didn't spike, the 10-year finally breaks below 465 by Friday's close. PI Thursday was flat, about as soft as it gets. Claims came in basically in line.
Both boxes checked.
And the 10-year?
Never got there. It was sitting at 466 one Thursday, and by Friday it was still parked right around there. 466, 4661, take your pick of the notes. Never touched 465, let alone broke it.
Close, though.
Close doesn't cash. That's a loss, and it's not even mine. I'm just the one who has to say it out loud.
You inherited the chair. You inherit the call. 12 and 11 now, streaks at -4.
One must hope not.
Marcus, yours is faster to grade. If Applied Materials Guide cleared $9.2 billion, semiconductor equipment names gap up broadly on Friday.
It cleared it by more than $1 billion, $10.25 billion guide, and the group did not gap up. Applied Materials itself fell 5%, and technology was Friday's laggard sector specifically because of it.
So the set of half of your call landed. The market's response didn't.
Same problem Ashley's inherited call has. Honestly, I called a mechanism. The mechanism just didn't move the tape the way I'd bet it would. Take the loss.
12 and 11. Streak resets to -1. 2 losses to open the board this morning, and neither one of you actually got the number wrong. You both got what the market would do with the number wrong, which is, weirdly, the whole theme of the week, and we're about to spend the next 20 minutes proving it.
That's a generous way to frame 2 losses.
I'm not done either, because now we grade the ones that actually matter, the calls from a week ago Sunday, checkable all the way through Friday's close. Eleanor's was on the 10-year, closes Friday above 470 if CPI and PI both ran hot, holds under 460 if both came in soft. Both came in soft. Both came in soft. Cool CPI Wednesday, flat PPI Thursday.
So under 460 is the bet.
And Friday's close on the week, the desk has it climbing to about 466. Not near 470, but nowhere close to under 460 either.
Which means the whole premise held. The data came in exactly the soft way the call needed, and the number still didn't go where the call said it would. A single soft print can move the long end several basis points in a session, and this week it just kept moving the wrong way for this call. That's a loss, and it's the same yield stuck at the same level, beating the same seat for the 3rd time this week.
12 and 12 now, streaks at -5.
I've been in this chair 2 days.
For what it's worth, that's not your streak. That's the streak.
It's mine now. That's how this works. You told me that yourself yesterday.
He's not wrong, and you're not wrong either. We'll get back to what actually broke that call in a minute, because it's a real story, not just bad luck. Marcus, your week-long call is the one that saves your morning.
It better. Mine was on CoreWeave-and-Nebius. If the backlog actually converts to revenue this week, not just gets restated. The group grinds higher into Friday, regardless of what CPI does.
And
it converted. CoreWeave's margin actually inflected 5% adjusted operating margin against a 2.7% estimate. And Nebius didn't just grow revenue, it flipped EBITDA positive, $236 million, against a $21 million loss a year ago. That's not a bigger promise. That's the promise turning into a number you can actually bank.
And the stocks?
Both up big the session they reported, and nothing this week reversed it. No concentration scare, no dead headline, no walkback. The group held. That's a win. Clean.
13 and 11. Streak flips to positive 1, down 2, up 1, all in the same segment, which might be a record for how much a scoreboard can move in 5 minutes.
I'll take a net win on a rough morning.
Sarah and Dave are still on the bench for the season record. 0-1, 0-2. No fresh calls to grade there this week. Though, Dave, we do owe you a check-in on your own amended call before we're done. Final tally walking into today's retro: Ashley 12-12, streak -5. Marcus 13-11, streak +1. That losing streak is going to matter in about 10 minutes, so hold on to it. Let's get into the week itself.
Please. Anything other than my own scorecard.
Thread 1, and it's the biggest one, the Fed pivot. Because 3 weeks ago, we were talking about a hike, not a cut.
We were. Fed funds futures had something like an 82% chance of a September hike, priced in right after Chair Warsh's July 29th press conference. His no magic wand line on inflation, market took it completely literally. That same contract is pricing hike odds at around 19% now. 82 to 19 inside 3 weeks.
What actually did that?
A soft jobs report, mostly. Negative payrolls back on the 1st, plus revisions that made 2 prior months look worse than they looked in real time. That reminded everyone the labor side of the Fed's mandate still exists, and it did more work unwinding hike bets than anything Warsh himself said.
And then this week's data just kept confirming it. CPI landed right on consensus Wednesday, PPI came in flat Thursday, and the S&P did what it always does when the inflation story cooperates. Record close Wednesday, another one Thursday.
First time above 7,800 in the index's history.
First time ever. 7,798 and change Thursday. And the VIX told you exactly how much conviction was behind it. 14.3 by the end of the week. 4th straight weekly decline, lowest since January.
Which is the good version of low volo. A market that's actually resolved its biggest.
Resolved is generous. High yield spreads are sitting near 2.7% against a 20-year average closer to 5. That's not resolution, that's a market betting there's nothing left to resolve. Those are the same thing.
Fair distinction. I just don't think you get to 82 to 19 in 3 weeks without the underlying data actually deserving it.
So even inside a thread, you two agree on cooling data, Fed on hold. There's still a real seam in how much you trust the calm underneath it.
Always.
Thread 2, and Dave, this is yours. The loudest run of AI infrastructure earnings we've had all summer. 5 straight days of it.
Genuinely, I don't think there's been a 5-day stretch like this all year. Monday, CoreWeave and Supermicro. Wednesday, Nebius and Cisco. Thursday night into Friday, Applied Materials. And Friday morning, Cerebras' first quarter as a public company, which we'll get to separately because it's its own thing.
Walk me through what actually confirmed versus what got punished. Because the pattern this week was strange. Good numbers kept getting sold.
It's the cleanest version of a trend we'd already started tracking. Beat and raise isn't the bar anymore. It's beat, raise, and don't scare me on whatever the markets decided to worry about that specific day. CoreWeave-and-Nebius cleared that bar. Cisco and Applied Materials didn't, and it wasn't because the growth was fake.
Cisco's the cleanest example. Beat on both lines, raised full-year revenue guidance from around $63 billion to a range of $72 to $73.4 billion. That's not a token bump. That's the street's whole model getting rewritten in one release. And the stock still fell, because gross margin compressed about 210 basis
points on the mix shift toward AI hardware. Yeah, I know the number. I still think that's the wrong thing to be punishing. And I'd still argue that's the market punishing the wrong variable. Full-year AI infrastructure orders hit something like $9 billion for the year. That's real demand. Margin's a mix issue, not a demand issue.
Sure, but the stock doesn't know the difference between the demand's real and I'm not getting paid enough for it. The reaction's the reaction.
Same exact story, 2 days later with Applied Materials. Record quarter, $9.12 billion in revenue. Guide up to a range of $975 to $1075 against a street number near $954, and it still fell 5% Friday.
Why this time?
China. They flagged $600 million of fiscal 26 revenue impact from export controls, on top of money already lost this quarter to a rule that got suspended and unsuspended mid-quarter. Different variables, same instinct. The market's decided it wants the beat and raise, plus 0 surprises on whatever the one controllable risk is that quarter.
Margin for Cisco, geography for Applied Materials, and coherent, got hit a third time in 4 quarters, for basically the same reason, a beat with no story attached to why it should keep beating.
So what's the actual proof this week that the demand itself is real, not just a story everyone's still willing to believe?
Nebius, honestly, more than anyone. Revenue up 454%, and for the first time, you've got EBITDA actually positive, $236 million, versus a $21 million loss a year ago. Annual recurring revenues at $3 billion, up from $1.9 billion in March, and they layered on a $1 billion multi-year deal with Reflection AI on top of the Microsoft and Meta contracts they already had.
Which I'll give real credit to. That's the actual delivery, not another backlog announcement dressed up as one. My but is the same one I'd have had midweek. Their own CapEx plan for the year is $20 to $25 billion, and operating cash flows nowhere close to that gap. So there's still a real financing question sitting underneath one very good quarter.
One profitable quarter doesn't retire the math, sure. But it's the first quarter where the math started moving in the right direction, instead of just growing wider. And that's new.
CoreWeave backed up the same story from the other side. Backlog went from $104 billion to $129 billion in 6 weeks, and the margin actually inflected this time, 5% against a 2.7% estimate. Stock popped 19% the same night.
So 5 days, 5 prints, and the takeaway is an AI infrastructure is a bubble, or AI infrastructure is definitely real. It's that the market's now pricing every single one of those companies on a different, harder variable than pure growth.
That's exactly it. The growth question got mostly answered this week. The question now is, who gets to keep the multiple for delivering it?
Dave, before we move off this, you've got an active call still on the board. The customer concentration thread from Datadog's scare a few weeks back. Anything from this week's earnings that touches it?
Nothing. Not a word about customer concentration in any of the 5 prints we just covered. CoreWeave, Supermicro, Nebius, Cisco, or Applied Materials.
Good or bad for your amended call?
Good. Actually, by the rule I set for myself, if nobody flags it this week and then Snowflake or MongoDB do at the end of the month, that's evidence it's spreading slowly. Not that it went away. Snowflake's the 25th, MongoDB's the 27th. Still pending, still on the board.
Fair, we'll carry that one. Real quick, human moment, because we've done nothing but earnings math for 15 minutes and I need a breath. Ashley, day 2 in the chair. And it's a Saturday recording, which I know nobody warned you about.
Nobody did. I showed up in a blazer like it's a
Tuesday, yeah? Rookie mistake. I learned that one the hard way months ago.
I didn't even bother changing out of what I wore Sunday. Consistency is a brand.
All right, back to it. Because the next story is the one where you two actually split, and it doesn't close by the end of this segment either.
Cerebras.
Cerebras. First quarterly report as a public company, and the stock got hammered. 14 to 18%, depending on when you're marking it, off a run from $185 IPO price up to $350.
Depends entirely which revenue line you trust. DAP revenue, the number regulators actually make them lead with, came in at $180 million against $194 expected. A miss. And hardware revenue, the least dressed up number in the whole release, fell 23% year over year.
I think that's the wrong number to anchor the whole story on, though. Their own preferred metric, core revenue, folds in the cloud and inference contracts, grew 103% to $210 million. Cloud and services alone nearly quadrupled. That's the OpenAI compute deal actually
Showing up in a number, sure, I'll grant that part. Give me a number, not a vibe. Though, $25 billion in backlog doesn't mean anything if the chips themselves aren't the thing winning the deals.
I'd call that an accounting framing problem, not a demand problem. Cloud and inference is 61% of core revenue now, up from 27% a year ago. That's the delivery. Same shift we watched Nebius pull off 2 days earlier.
Except Nebius turned EBITDA positive doing it. Cerebras posted a $450 million net loss.
Most of that's IPO stock comp, one time, not operating.
Some of it. R&D still running near half of sales, that's not a rounding error.
And yet 3 desks raised or held their price targets the same morning the stock cratered.
Wedbush and Morgan Stanley raised. Citi trimmed the target but kept the buy rating. Nobody on the sell side is calling this broken.
Or analysts don't want to be the one who downgraded the NVIDIA Challenger stock the week it's the whole market's obsession. I've seen that particular movie before.
We're not resolving this one today. Same as Friday, the marker's simple. Watch next quarter's hardware revenue. If it stays negative and the loss doesn't narrow, Ashley's read wins. If Gap catches up to what the core number's been promising, Marcus's does.
I'll hold there.
Same. And I still don't think I'll be conceding it.
Thread 4, and this is the one that actually explains why every yield call on our board lost this week, Friday itself, because it was two completely different days wearing one ticker.
This is the split screen. Through Thursday, the week was a straight Goldilocks story. Cool CPI, flat PPI, records almost every session. Friday morning, retail sales fell 0.6%, the steepest drop in over a year against a call for a small gain. And the University of Michigan's consumer sentiment read came in at 51, down from 55.2, missing the 55 forecast, with the weakest numbers concentrated in older, lower-income, non-college households specifically.
And the index barely blinked, S&P down about 0.2, Nasdaq down a bit more, Dow basically flat. What actually moved was the Russell 2000, up about 0.5% to a fresh record, the strongest thing on the board the same morning. Consumer data cracked.
How do those two things happen on the same day?
Because it's not one signal, it's two different economies getting priced at once. The earnings and liquidity economy that just spent 4 days grinding to records, and the household economy showing real strain at the low end. 7 of 11 sectors still closed green Friday. Testing out a broad flight from risk. It's real information sitting underneath the headline number that looks almost boring.
I'd add the piece that actually explains the yield calls specifically, oil. WTI's up more than 7% on the week, and Friday morning officials said the naval blockade around Iran could hold indefinitely. That pushed the 10-year right back toward
466. Same morning, soft consumer data should have pulled it lower, which is exactly the mechanism that beat every single rate call we graded at the top of the show. The data did what the calls needed. Oil did the opposite, and oil won.
So it's not that 3 separate people were wrong about the Fed this week.
No. Everybody read the Fed correctly. Noted priced in a fresh core moves headline landing the same morning as the data. That's the actual lesson, and it's not a comfortable one to end a losing streak on.
Let's crown the week then, because that split is basically the whole story in miniature. Call of the week, and it's not close. Marcus, the CoreWeave-and-Nebius basket.
I'll take it.
Tell them why, though. Because it's not just a green arrow. You didn't just bet the stocks would go up. You bet on the specific mechanism, backlog converting into recognized revenue, not just growing bigger as a promise. And then Nebius flipped EBITDA positive and CoreWeave's margin actually inflected in the same week, confirming the exact thing you staked the call on.
That's the part I'm proud of. Anyone can guess a stock goes up during earnings season. The bet was on what kind of print would prove it, and the print showed up exactly that way.
I'll second it. It's the one call this week that taught me something about how to read the group going forward, and I say that from the losing side of the board.
Miss of the week. And Ashley, I'm not going to make you own this one alone because it's not really your miss. It's the 10-year yield, full stop. 3 separate calls this week, 3 different people all betting some version of the data cooperates, so the number moves. The data cooperated every single time. The number never did.
It's still going on my card, though.
It is. But the honest version of the miss is bigger than your card. It's that an oil headline out of the Gulf beat cooling CPI, flat PPI, and soft retail sales 3 separate times in 5 days. That's worth sitting with more than any one loss is.
Cold comfort, but I'll allow it's the right lesson.
Here's the week in one breath. The Fed pivot that looked locked in Sunday got exactly the confirmation it needed. CPI on consensus, PPI flat, high gods collapsing from 82 to 19% in 3 weeks, and the S&P closed above 7,800 for the first time in its history because of it. 5 straight days of AI infrastructure earnings proved the growth is largely real, while quietly raising the bar to beat, raise, and don't scare me on margin, geography, or gap. Ask Cisco, ask Applied Materials, ask Cerebras, all punished this week, despite numbers that would have been champagne-worthy 18 months ago. Nebius and CoreWeave were the exception that actually delivered, not just promised. And Friday flipped the whole script. A real crack in the consumer, a record for small caps on the same morning, and an Iran headline that beat every rate call on our board even when the data did exactly what it needed to. Ashley's chair opens week 2 at 12-12, a 5-game slide that isn't really about her calls being wrong so much as the tape refusing to reward being right. Marcus climbs to 13-11 off the best call of the week. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts and find our written notes at novaventures.us. That's your Saturday wrap. Have a good weekend, and we'll see you tomorrow for the weekend.